Welcome back to our ongoing year-ender series, Markets in 2025. Today, I have with me probably one of the best of experts, Timothy Moe, Chief Asia-Pac Equity Strategist and Co-Head of Asia-Pac Macro Research at Goldman Sachs, to tell us how markets may pan out in a Trump world. Good morning, Mr. Moe. Thank you very much indeed for joining us. Well, first up, do you think that, U.S. exceptionalism is going to continue in 25? And will that draw money away from EMs as a basket?
I think it already has, to be frank.
Yes.
We have to remind ourselves that the long-standing outperformance of the United States equity market means that it's now, in round terms, 70% of the global market cap. So you just naturally, money is going to be attracted there just to be at benchmark. And then, of course, post the U.S. elections, the narrative of U.S. exceptionalism has been strengthened, really because you've had three major shifts that have taken place from an Asia perspective, which are somewhat lower growth, really in China, but maybe rippling out a little bit further. Number two, higher rates, higher U.S. long-term rates, and maybe a somewhat more attenuated easing cycle. And number three, a stronger dollar. So basically lower growth, higher rates, a stronger dollar typically are more headwinds for Asia. And I think that's impelled some money to be shifting a bit more towards the U.S., which we can see from the aggregate foreign investor flows for the region, in the past month or two.
Yeah, point taken. But can it be a state of buy the rumors, sell the news? When Trump actually gets sworn in on Jan 20th, would it be difficult for any president to, impose tariffs across the board? The inflation problem for his own countrymen will hit home. And so the markets perhaps would have already bought into it and probably used 2025 to ease off. Is that a possibility?
Latha, it certainly is a possibility. And I think there's a few elements to your question, which just to unpack it. One is that the U.S. has already rallied quite sharply since the election. And even though we established a 6,500 S&P 500 target for end of next year, we're already closely approaching to that. And there's only maybe 7% upside to that, with the U.S. market as of Friday's close trading above 22 times earnings. So clearly there's a lot more in the proverbial shop window, so to speak. So that's number one. Number two, just to be clear, our base case is for the U.S. to impose an additional 20 percentage point increase in tariffs on China and some tariffs on auto exports from Europe to the U.S. and from Mexico to the U.S., but not the across the board 10% tariff that had been threatened or raised as one possibility. If that indeed happens, that would be much more negative for global growth, but also would have impact on the U.S., both through the inflation channel and the growth channel. So we think that is not our base case. It's a risk, but not our base case, just to be clear on that.
Okay, well, point taken. I'm just wondering if a bulk of the U.S. exceptionalism has paid out. But let me come to India. And while we have prided on being the fastest growing large economy, I'll come to the domestic slowdown in a bit. But do you think 2025 can mean more headwinds as businesses all over the world grapple with the uncertainty of tariffs and probably even bans in investments?
The quick answer to that, Latha, is yes. But let me just explain why, and then maybe make a comment on India as well. So we've shown in a number of our research, whether it's macroeconomic or the strategy research that my team has been doing, that there's a transmission channel from what we call economic policy uncertainty, and trade policy uncertainty is a subset of that, and the impact that can have both on economic growth and also on earnings. And the simple way to understand that is that when you're uncertain about what the operating environment is going to be, which is what policy uncertainty attempts to capture, then you typically would have entrepreneurs not invest as much. So your capital expenditure may not be as great. And therefore, that might have an impact on both economic growth and on earnings. And indeed, we've shown for Asia that there's a clear linkage between increases in global economic policy uncertainty and Asian earnings. And also, for example, in Europe, we took our forecast down from 1.1% for euro area GDP next year to 0.8%. And a good part of that was through that trade policy uncertainty channel. So I think that there is a direct connection there. Now, I'd say the better news for India specifically, which of course is, what your audience is focused on, is that India is, more of a domestically oriented economy. It's got much more domestic engines, as you well know. And so, it may be somewhat affected by that, but certainly not as much as the more, globally trade oriented economies, whether it's China or Japan, Korea, or Taiwan. Those are much more in the crosshairs of that concern.
Okay. Oh, yes, I get that point entirely. But, the great Indian story of growth of the last 3 years kind of lost its sheen a bit when we got the July-September GDP growth, which came in at just 5.4. Market expectations were at 6.7. So do you think, I have your report, Sunil Kaul's report on the earnings expectations. Do you think you all will have a downside risk to those estimates?
So let me just be clear. So we love the India story and have done so for quite some time. That being said, we downgraded our view on India about 6 weeks ago. And really the reasons were twofold. One, that valuations have gotten very, very high. On September 26th, which was the peak of the market, it were over 25 times forward earnings. And number two, we expected there would be some sort of what we call a mid-cycle correction, both at the economic level and at the earnings level. So directly to your question on earnings, yes, we have taken our numbers down, and as has consensus, at the end of September, we were looking at 14% and 15% 2024, 2025 growth. We're now looking at 12 and 13. So we've taken about 2 percentage points out of each year, and consensus is done roughly similarly. So we're still a bit below consensus, but both we and consensus have taken our numbers down. And that's clearly because it was a soft reporting season for the fiscal second quarter, calendar third quarter. And looking forward, we think that's going to persist for the next maybe 1 to 2 quarters. So, we were basically calling for that sort of mid-cycle slowdown. And in the context of elevated valuations, we thought the market was due for sort of a period of, range trading and consolidation. That is kind of what's been happening. And we think that's going to persist for a little while longer. But looking forward, we think that that should hopefully afford an opportunity for investors to re-engage, for another leg up in the market, but one that might be, not until sort of the middle of next year.
Okay. I know you'll have other experts looking at currencies in particular, but overall, since you have to advise equity investors, how much of a worry would you have on the rupee, not just because of the dollar strength, but also because, exports, dollar inflows that are likely to be stymied, primarily because of US exceptionalism. Do you expect that the rupee could be impacted, or could it be the converse, that India gets included in more bond indexes and therefore there are other kinds of flows? And the big one, do you expect a rating upgrade, which can change the terrain a bit on the currency front?
Your question is well asked, and the ingredients of your question highlight that there are both positive and negatives, as there always are, but there are important positive and negative ones. Look, our bottom line is that we think that there may be some modest weakness for INR, for the rupee, but in a strong dollar environment, which our base case is that we think that the dollar will remain higher or stronger for longer, and that most Asian currencies will depreciate modestly from current levels against the dollar. They already depreciated some, but maybe a little bit further. Within that spectrum of currencies in Asia, we think the Indian rupee is likely to be one of the stronger ones or the more resilient ones for a host of reasons, having to do with the fact that the economy is growing well, that the external dynamics that contribute to currency moves have improved in India's case, certainly in the decade since we had the so-called taper tantrum in 2011, when both the Indian rupee and the Indonesian rupiah were the weakest in Asia. There's been very significant changes since then. There's been some fiscal consolidation, which of course is fundamentally supportive of the currency. Oil prices are low, which is one of the traditional areas that's been a vulnerability for India on the external front. So we actually feel, pretty constructive on a relative basis, but recognize that in a broadly stronger dollar environment, that there may be a bit of further weakness, but as I said, less than for other currencies in the region.
Okay. So you are factoring in a lower dollar. Yeah, I think you are above 85 or something. I read the report.
Correct. Yeah.
Yeah. Timothy, I know the nitty-gritties, the micros of India are Sunil Kaul's area. But broadly, what are the sectors that you would look at? I think you are very positive on the affluent Indian story.
Yeah, absolutely. So in terms of sectors, it's a bit of a potpourri because we're really playing off a number of different themes that we like, as well as trying to balance, liking the underlying growth story, but recognizing we need at least, for the next maybe 1 or 2 quarters to be a little bit more tactically conservative. So we've got, as I said, kind of a mix, which includes the IT sector. We kind of upgraded that for a variety of sector-specific reasons, including the fact the valuations look better. We like the auto story domestically. We like the telcos. We like the internet, which is sort of the subset of that is e-commerce, travel, and so on. We like insurance and also like the real estate story. And we're kind of so-called paying for that by being underweight financials, which would be the banks and the NBFCs, cement and chemicals, the oil marketing companies, and durables. That's kind of how we're balanced within the market.